limit down today. I think last time that I checked, it was down about close to 5%. I haven't checked it since, but once again, I think we kind of like talked about the position structure, maybe some shorts getting into it, but we talked about it offline. At some point in time, a reversal may be in store, but you got to wait for the right price level in order to kind of cover any type of long position. So, but I'm not too sure. I can actually look it up while we look at the performance here year to date.
Yeah, so it's very true. When you're looking at any trade, the only thing you know is it's going to end at some point. There's people who will pound the table on things and tell you that this is going to happen or this isn't going to happen. I'm kind of the opposite of that. I think as a trader, you have to be really open to, hey, this can end. Hey, this is, I don't know where something ends. And that could be up 5%, or that could be up 162%. You just don't know exactly where that's going to end up. So once again, when we're looking at all of these, we got cocoa up 160%. We've got, and this says 162, and I just screenshotted it. I'm looking at the live right now. It's 160% now, so it dropped another 2% recently. Coffee up 24% year to date. Crude oil Brent 18%. Copper 18%. Orange juice almost 18%. So the commodities are still holding up relatively well considering all the things that have happened in the last few weeks. And once again, it's cocoa being the most interesting thing. Everybody wants to talk about it. Had a great conversation the other week with Jerry Parker. Jerry Parker has been a guy who's been in trading and trend following for longer than I've been alive, actually. So he's been doing this for a long time. He knows his stuff. We had a great interview with him. If you check out our channel, you can see a bunch of stuff. But basically what we were having a conversation of is, cocoa being such a major piece of people's portfolio is sometimes the problem. But also, I think there's another way of looking at it too, which is sometimes you have these huge trades in your portfolio and they're going to make your whole year. I'm not saying like size big, but I'm saying for me, if the position starts small and it earns the right to be this large piece of my portfolio, I let it be that large piece of my portfolio. But I also know that this is going to end at some point. It's going to come back. It's going to take out a recent low, and that's going to be where I get out. But for the most part, for me, no matter what happens, we're up over 200% on the trade. Very happy with that trade. It looks great. And then just kind of across the board, the commodities have really kind of continued to hold up well, trending well. Gold and silver, they're starting to give a little bit of those gains back too, but they also don't look like they're done with the uptrend. So what are you seeing in this market, Kevin?
Yeah, definitely. So for cocoa, the ICE contract does not have a limit up, limit down feature right now. And it actually looked like there was a report. There has been people asking for it, but ICE declined it. So, so let's talk about the different markets here. So for gold, there was an interesting thing that happened last night, and everybody on Twitter is talking about it. People are probably sick of talking about the yen. So let's kind of just let's get this situation out the way here. So the yen did hit 160 US dollar yen pair. That finally was the threshold, according to the Wall Street Journal, where the BOJ actually did step in and try to mitigate some of the issues that are happening with that volatile currency. Now, we always have to kind of keep in mind the yen is always volatile, no matter what. It's more volatile now than what I've seen over the last, let's say, 10 years. But it is known to be a volatile currency. That's why a lot of speculators like to get into these yen pairs, no matter if it's US dollar or if it's euro yen or if it's Swiss franc yen, which is actually very volatile, let's say at least here. But so we had that situation happen last night. But one thing to just kind of keep in mind, right? The headlines are going to tell you this is what happened to the yen. There's a crisis, yada, yada, yada. But if you actually look at the structure leading up to it, and I sent you a chart on this one, the comp, if you look at the gold contract, gold futures compared to the US dollar yen, gold actually was sliding. Somebody was selling into this yen move yesterday evening here. And I find that to be very, very telling. Usually if we saw gold slide to the downside, we may have also then seen the yen strengthen, not weaken at this point. And actually, when the situation actually occurred, gold fell, And then we saw the yen obviously weaken, and then we had this like recorrection happening, and then it tried to retest, and then that's when you saw the BOJ actually stepping in here. So what does that mean? What I try to bring up for this? I think what happened is there was probably a very large institution, and we don't know if it's a central bank, we don't know if it's a large trading arm of some firm, what have you, but they may have had a pairs trade in. From what it appears like it actually happened was a pairs trade where they were maybe long gold, so they were long gold and maybe long yen in order to make that spread, right? Which is an odd trade to say the least, if you kind of think about it. But from a structural standpoint, there may have been some merit there. Trying to see the yen bounce and then seeing gold move to the downside here. Yeah, so I have that like little purple line there, kind of like in the middle, so you can kind of see that selling off where the yen pretty much wasn't doing anything. It came down, hit a low, bought back up, selling pressure again, and it looks like that's where you see just this strong impulse buy into the dollar, weakening the yen at the same point. Once again, we'll probably never know, but I think this is more of a deleveraging event for an institution rather than something that structurally broke for the yen yesterday. But the BOJ had to take action because we did not want to see a domino effect where everybody else was freaking out, which is why you're kind of seeing that plateau-ish situation and then moving to the downside here. But now we know what their threshold is. It looks like 160 is the ticket. And now the market's going to see if they're going to call its bluff and try to push it to 160 again, or if they know that that's that line in the sand and maybe this unraveling of being short yen is starting to take place, which is another reason why we're seeing the dollar move back to the downside here. So I just wanted to highlight the correlations that we have seen between these two pairs, US dollar yen versus gold, briefly broke for about 40, let's say 30 minutes yesterday before leading to that major event. Somebody knew something, there was a structured trade that was out there rather than this, news hitting the wire and people just freaking out and then trying to cover. That was not the case for yesterday. So I wanted to really highlight that and give color because once again, the banner headlines are going to tell you something completely different than the underlying structure. And it's important for people to understand what actually occurred rather than attaching yourself to a narrative, because a narrative and trying to attach yourself to a narrative right now could actually hurt you on this yen pair if you're trading it. So that's what I wanted to kind of highlight. What do you think about it?
No, I love that. And this is honestly why, I work with you so closely on these things, because I think that just generally like looking at things, you have a good eye for just looking at things, understanding that there's usually something behind the move. When you look at the news flow in general for any type of trading, most of the time somebody already knows that before you do. So you really don't have much of an edge. So you really want to see the positioning. This is why the positioning is so important, whether you're looking at COT, whether you're looking at options flows, if you're a more short-term trader. However you do it, the positioning is incredibly important because you can see things are offsides. You can see somebody might know something beforehand. And also the price action. The price action, like sometimes the best breakouts occur and the best moves occur when you start to see some move before anything happens. And that could be the price action. That could be positioning, like Kevin's talking about. And if you're seeing that happening beforehand, sometimes somebody knows something somewhere, and you can take advantage of that. But if you just like Kevin said, like if you're just watching the news flow and you're reacting, like that turns out badly. Most of the time for most traders, I haven't seen any trader ever actually have a good way of doing that in a consistent way that can continue to make money profitably over time.
Yeah, and the reason why I kind of bring this up once again, seeing that move and seeing the headline of 160, the traditional thought process would be, okay, long gold, right? But if you kind of look at it, gold has backed off. Now, obviously, the yen backed off here a little bit, but gold was for the most part kind of backing off a little bit. So yeah, we have to understand the reason why. Once again, we probably don't know who was the trader. It could have been a central bank, and it could have been, but it could have been a JP Morgan. Who knows? We're all just speculating here. But knowing the lead up to an event and seeing that break in correlation kind of signals to me that somebody was trying to offload a significant amount of positioning, especially on the gold side, and then being able to right size that or be able to cover their long yen thesis, basically getting back into the dollar. And when you're talking about currencies, everything is relative. It's not like a stock where it's like, do we just buy it? Do we sell it? Is the company good? Is the company not good? You can have a really strong Japanese economy, but you could have a stronger U.S. economy, and that could still provide strength to the dollar rather than the yen, even though there might not be anything structurally wrong with Japan's economy. I'm just using that as an example. We know that there's cracks in pretty much every economy right now, but you have to think of the relative nature that was actually taking place. And that gold move was the only thing that was actually front loading or front running yesterday's yen pop, or yesterday's yen drop, and then subsequent kind of pop today.
Yeah, no, that's completely right. And I just wanted to put up this long-term chart of the US dollar yen pair. Once again, it's a people ran to the yen for years, but there's been so many things wrong with doing that for so long. But it still continued to have some sort of relative strength to the dollar, speaking to what Kevin was just saying. So kind of we were seeing that for so long. Now we're at a different point in the market where we're kind of seeing this structural change in the US dollar yen pair. Also, the yen has been historically a deflationary currency or disinflationary currency. Most of the time when we have a disinflationary period, we see people kind of rush to the yen. 2022 was a very interesting one where it was the opposite. As you see there, the US dollar spikes against the yen getting into the 2022 period. So people at that point really started to go, hey, they've had negative rates for so long, their economy, their demographics, and so on look like this. We're going to see a structural change in that trend. And I think that trend has just continued, and it's changed regimes. So now that regime where people could run to it as almost a safe haven currency, similar to the Swiss franc or even the US dollar at times, now people are going, hey, I really don't want to own the yen anymore. So once again, they're kind of coming in. It's been an interesting thing we've also been talking about too, which is this shift into a different regime where negative rates and all of these things are going to fundamentally change. And so as we kind of see that change, we're going to see whose economy can really sustain that type of change going forward. And once again, for me, I'm not exactly sure who's exactly set up to do that well, considering the way the world has gone for so long. I'd like to see rates continue higher. I'd like to see a higher median for all of these going forward. But once again, there's a lot of cracks in the economy for doing that. But once again, I think there's a plus to doing that as well.
Yeah, I agree with you, right? Like every economy has cracks in their armor right now, and they're all different. And so you kind of have to be pick and choose which one you want to dabble in, right? United States economy is actually doing pretty well. We had a GDP print last week on Friday that came in or Thursday at 1.6%, and people were freaking out about it. But if you kind of looked under the hood, a lot of that was inflationary pressure. We knew that the PCE for that particular print was going to come in hot for the quarter. And then you had a situation also where inventory levels were moving to the downside. Now, that's kind of a counter trend type of scenario, especially when you're talking about the calculation of GDP, right? So if I have lower inventories, does that mean should we actually negatively subtract that from gross domestic product, where that also could be an indicator of strong demand and strong growth, right? Like at the end of the day, the reflation trade type of situation that we've been kind of talking about here. Now on Friday, we had the PCE print that came in, the monthly one, and the consumer spending numbers were actually really healthy. I mean, it beat the street's expectations by almost 2 times. And so you're going to see a complete readjustment. Consumer spending has a direct correlation or a direct influence when it comes to GDP. So much so that the Atlanta Fed has moved up their Q2 target for GDP up to almost 4%. I think it was actually 4%. It's either 3.9 or 4. That's also kind of leading to the fact that we will see potentially some positive revisions when it comes to GDP. And we can negate that 1.6% print that was on Thursday and the stagflationary fears that people had in the near term. Now, can stagflation actually occur? It might, but I think it's going to take us a long time. And when I say a long time, this time next year for us to be able to capstone that particular idea. But United States, fairly strong. We do have a debt bubble right now on the government asset side that I think people are kind of being mindful of. But when you look at the other major economies that are out there, who doesn't? right, for China, and they're starting to stimulate and trying to stimulate, and we see copper continuing to rip to the upside with long positioning and really good bullish thesis. China's going to have to securitize that debt in order for them to provide that stimulus. So when people talk about Russia, we don't look at them one-to-one because, you know, we don't have all the input, and some things could be changed from Russia and not that back and forth. But Russia, from a currency standpoint, fairly weak. From a debt load standpoint, you know, they're kind of extended as well, a little bit different way of how they issue debt and how they're able to manage some of their multinational or their national companies. But if you kind of look at it, everybody has problems. So what's the best house on the block right now? It's the US. But at some point, you got to look at some of these other economies and say, okay, there might be a bottom here. That does occur. And you might want to see that for the dollar. I'm right there with you when it comes to yields. 10-year, 20-year, 30-year. I'd like to see those continue to move to the upside. I'd like to see a normalization of the curve before we cut that bear steepener that everybody hates and is fearful of, just like everybody was fearful of the yield curve conversion that we've been in, our yield curve inversion that we've been in for what, almost 2 years now. And it really hasn't phased anything. I think that bear steepener would actually be a good thing. And then if you have the Fed cutting on the back of that, I think that would actually be a plus for the long-term foundation of the economy. And I'll just explain this real quick. The yield curve right now is inverted, meaning shorter-term duration yields are higher than longer duration yields, which is not normal. If you are any type of speculator out there, anybody that's buying assets, you know, Jason, right? The longer you have as far as time, the more yield that you want to have because you have time on your side. There's also other risks that are out there. In a normal market, we would have higher yields. So right now we're in this inversion. I'd like to see that flatten out, then steepen, and then getting cuts on top of that would then pretty much leave those short-term rates down, and that's where we kind of get this catalytic move to the upside, that real stimulus pressure to the upside. I think that's going to be a key area there. I know I kind of went long-winded, but it's kind of the yield environment that we're in right now.
No, you have to. I mean, I think anybody who understands macro, I think that's the thing. I had somebody write me the other day and they were like, yeah, you know, I'm just not like all about commodities, you know, so what you do is cool, but like I do something different. And for me, it's like, no, it's all connected. Like I trade everything. Like I'm not, you know, I've made trades in certain sectors and obscure countries like Turkey and so on. Like I'll trade anything. And the way I do that is because I understand the macro. I understand the way the commodities are moving and they're all connected. So when Kevin goes through something like that and he's going, I'm kind of going off a little bit. I see it as, and the rest of you guys should see it as, hey, all this stuff's connected. This is how it works. When Kevin's talking about China and then he goes to copper, there's a reason for that. It's because they're also kind of go hand in hand. Those trades are kind of very similar most of the time. And if we look at all these countries here, and I just went and brought this up a second ago and took a screenshot, you know, you're seeing the U.S. year to date is still doing pretty well, right? So we're seeing, you know, Turkey obviously leading the way. Very hard thing to trade. I have Kashop. Actually, everybody knows Kashop, so I'll just say his name. He knows that I have this like Turkey ETF in my system, and I never talk about it publicly because I know it's a very hard thing to trade. The currency is really tough, but it's interesting to see Turkey kind of leading the way. But we see some things starting to catch up, and then if we go into a 1 month time frame. And let me pull that up here again. So if we go into a monthly time frame, this is something that I found really interesting the other day in the last report. You're starting to see everything is kind of taken over the U.S. You're seeing the U.S. actually on a 1 month time frame is down 2.5%. And then above it is Brazil, is Taiwan, Saudi Arabia, Qatar, Canada, Sweden, India, and then you go up the list and you see, you know, once again, Turkey's leading the way. I know not a lot of people trade it, but China is also right up there. It's up 6% in a 1 month time frame. So, you know, we're kind of seeing all this strength going to all these different areas. And the areas that I'm seeing, and that's the thing to really pay attention to here, and also pertains to what we do here, which is the commodities. A lot of these are commodity producers, or they're incredibly tied to commodities in some way, that they're moving nicely in this type of an environment. So once again, it's a we have this reflationary environment, but it doesn't just mean, hey, buy energy and walk away. Hey, buy copper, buy oil. It means there's different countries out there that you're going to want to start to look at and be positioned in to start taking advantage of. I mean, things like, I know a lot of people are going to trade Saudi Arabia, and not a lot of people are going to look at these type of things. But once again, you really have to start paying attention to these. You have to pay attention to the fact that China, if you look at it on a 1 year basis, you start to see that it started to bottom out and it started to actually break out. It's making 50-day highs, then it's making 100-day highs, and it's continuing to move higher. So once again, I would be very interested to see where that China trade continues to go. It's kind of like people always say, there's always a bull market somewhere. Like you don't just want to buy tech and sit on your hands for the rest of your life. If you're a trader, like if you're an investor, sure, do whatever you want. That's not what I'm talking about here. If you are a trader like we are, and you're in and out of sectors, monthly, quarterly, whatever, you're going to have to continue to position yourself in strong areas. And these are the strong areas right here. And looking at China, I could see China being a takeover there. And that also has to do with copper. So what are you seeing in China and copper right now, Kevin?
Yeah. So, look, I think it had to be a couple of weeks ago, maybe even a month ago, we kind of talked about copper. And I wrote about copper in October of last year. People that follow me on X, they kind of know. In October, it was like, look, this market's going to be prepped for a short squeeze here. Everything was lining up from the positioning side, from the lack of supply that is out there, to the China reopening trade. I mean, everything was screaming that copper wanted to rip. It was just a matter of time. So now we're seeing that actually occur. And when I bring up a month ago, I kind of talked about, and everybody's different. So I'll differ from other individuals, especially when I'm looking at the commentary. When it looks at, like, when you're trying to trade China, it's a very hard trade to do on the equity side, right? Some of them are fairly low float. A lot of them have been shorted and continue to be shorted by very large institutions. You have the geopolitical risk that is out there, and then also the fear of potentially delisting or blocking of trading of said company. And people in the past, we always thought, well, that's never going to happen. And then towards the end of Trump's presidency, we actually did see it happen, with around 15 companies that were taken off the exchange because they had supposed ties to the CCP and all this other stuff, right? So I always find that a little bit difficult to try to trade the equities, but sometimes people just trade what they know. But the commodity side, when you're looking at copper, you remove all of that, the company-specific risk, the leadership risk within the company, the potential exchange problems, and you kind of just go straight to the fact of, are they going to try to grow? Are they going to try to stimulate? And how are they going to stimulate? And China, and rightfully so, they want to go to a services-based economy like every other major power that is out there, but it's going to be a hard transition. It takes decades upon decades for them to be able to do so. And so are they going to really try to do that right now? No, they're going to go back to the things that they know. They know their bread and butter. They have the capacity out there when it comes to refining, when it comes to the smelting operations, when it comes to the industrial production. They're basically exporting all of their deflation to the world here, which I kind of find very interesting that a lot of Western powers are upset about that, because you probably would want to see some of their deflation coming hit our economy here from a political standpoint, but I'll leave that be. So we have a little bit of a supply issue when it comes to copper. We know that what's happening in South America with some of the mining operations is also putting a little bit of pressure in. It takes around 8 years, maybe even 10 years to bring on a new operation. So we could have a short-term supply shock right now. And then China, their top major smelters, like 4 or 5 of them, I believe, kind of got together like in an OPEC type of fashion and said, hey, we're going to reduce our operating rates or utilization rates, because it's not the fact that they can't get iron or copper ore, which is the issue. It's not all of copper. It's copper ore is what's in short supply. They're importing as much as they want when it comes to, let's say, second demand or almost final stage copper, if you will, right? So they are trying to do that in order to boost the margins, the profit margins for a lot of their smelting operations out there. And so that's also kind of creating this weird effect that's happening to it. From a positioning standpoint, and I'm going to say this, and this is not going to be a popular opinion. And I'm not providing any type of advice here, but from a technical standpoint, we may have 15 to 20 cents left to go before I would get a little bit even more cautious than I were before. And I was cautious once this thing broke up to 420, as you kind of know here. It's at 460 right now. I always call it icing on the cake. If I say 420 and it hits 460, that's just icing on the cake. That's decent. But I think another 20 cents, 25 cents, that would bring us up to say 490, hitting some critical areas of resistance. But you still have the speculators and the producers still pushing prices higher. It's a cautionary trade. But what I would say is if you're looking at the overall metal complex in itself, from gold to silver to copper right now, and you had to pick the fundamental thesis, the structural thesis, and the technical landscape between all three, I think copper actually has the biggest bright spot right now. And I would think silver actually has the weakest spot right now. That 30 level is getting pretty hard. I'm not saying you completely fade it, but there are some. Silver is not in a scarce type of environment like copper, that copper is right now, quotations, right? There is, there's a fear, there's a, let's call it like a run on copper. There's a FOMO situation that's happening right now, but that FOMO is actually hitting the industrial market itself, right? Producers are like freaking out. There might be double ordering going on. There's a lot of that, where silver does have the capacity. We're just kind of like utilizing it as a proxy for the inflation move to the upside, the reopening for China, and then also kind of this gold pair where it has a better beta than gold does, right? So that's kind of the landscape that I'm looking at for copper. And once again, it could go a lot higher. I'm a conservative guy when I kind of look at the markets, right? Like if I have a technical thesis and a fundamental thesis, and it says, hey, I mean, this thing was trading at what, 340 or so. And if you're saying, trading around in October, it was trading at let's say 360, 365. I wrote an article on it on October 30th. And going up to say 420, hey man, that's actually that's a conservative thing to say, okay, maybe we can hit there. Maybe another $20, maybe it does fade. Who knows? I think it has a better fundamental thesis for copper out of any of the other metals, and I'm including gold, knowing what we have going on right now with the yield curve inversion, knowing what we have with all of the other stuff out there. Copper, I still think is a better look right now than gold. That gold reversal will be swift when it does happen. If it does happen, or when it does happen, it will be swift, where I don't think copper is going to be susceptible to that as much, because the speculative exposure to copper is just not as readily available compared to gold, or using GLD or things of that nature.
Yeah, no, I agree. And copper, the one thing that's always interesting to me is just the setup. Like, when you get out of anything fundamental, even anything, positioning wise, because yes, like the positioning is getting stretched. I completely agree with Kevin. If you look at it and you go, hey, positioning is getting a little stretched once again, but that's how big commodity trends usually start. So like Kevin said, that's sometimes that can be the thing that ignites this thing even higher. That can happen too. If I was playing it, like, let's say we were in range bound markets and none of the commodities were moving, and then we saw this spike, and the market wasn't conducive to commodities, and we saw this spike in copper. I would say, once again, it's probably going to come back. This is probably it, and then maybe we move higher later. But once again, the market's kind of very conducive to the commodities at the moment, and most of the time that can start a cycle. Now, the biggest thing that Kevin and I continue to bring up and talk about is the currency market. If we look at the dollar starts to break up. Like, let's say, we start to close over 106 and 107. That's going to put a lot of pressure on copper and the rest of the commodities. And that would make me go, okay, well, maybe my thesis is wrong. But once again, if we're looking at it just in, hey, the commodities are looking decent. Hey, we're starting to see some movements higher. The pullbacks are shallow. That's rare in the commodities markets. If you've been looking at these things as long as Kevin and I have, you see that the pullbacks are usually pretty harsh, especially if the trend isn't going to work or start to really move higher in a significant way. Those pullbacks are harsh and they start to get nasty. So the structure of the market that I'm seeing for copper is still higher. The structure of the market that I'm seeing for silver is still higher. But it's important to also know I'm a very long-term trend following trader. Kevin's talking about the immediate turns, and I also agree that like when this is extended to this degree, sometimes you can see these turnarounds. You're going to see a pullback, but it's important to just note like what does this pullback look like? Is it a strong pullback? Is it breaking like a normal retracement level, saying, is it retracing more than 50% of the move? When you look at it like that, you can go, okay, well, maybe the structure of this market is still together. I think it's important to have an idea of how you write down market structure and identify market structure going forward for yourself, because it's going to be different for everybody. Mine being very long term, that's how I'm going to look at it. Some guys are day traders. They're way more short term than I am. They're going to look at it a different way. Just figure out how you look at it. But I really like the idea of, like Kevin said, like it's not that I think silver is going to, I agree with Kevin, silver could be the laggard, but I just don't really see the scenario where these things start to go lower here. It doesn't make sense to me just yet. I still like gold and copper the most, copper above all else. It just makes sense fundamentally, technically, positioning wise. However, you never know who's going to be the biggest winner. I always say you never know where your biggest winners are going to come from. I couldn't have told you at the beginning of this year it'd be cocoa. I know that for sure, but it is. So I don't know which one. So at the moment, we're long all three. They're all in uptrends, and that's how I'm going to continue to play it until things change. What were you going to say, Kevin? I cut you off.
Yeah, I want to send you something. I know I'm late, man. I'm late on this. I should have gave you this earlier. All right, so I sent you. It's a PDF too, so hopefully it's easier to manage. I don't know what happened with that. All right, look. So copper saw about a 12,000 contract move to the upside last week when it comes to managed money. So once again, I talk about like kind of like late cycle type of behavior, right? Where usually speculators are like the last ones to kind of get on the train, and we start seeing then producers really try to sell into that strength. For whatever reason, this does not allow me to do it. So what I wanted to say is that if we looked at a longer dated chart for positioning, oh, okay. If we look at a longer dated chart of positioning, then we would, you would be a little bit more concerned if this is like late cycle behavior, if you will. I'm sorry, guys. I was trying to send that over, but I'm having an issue with it. So
what were you trying to look up? I could
the CME commitment of traders report, and just looking at the managed money flows. For whatever reason, actually, I can just do this real quick. Give me 1 second. I'll do this because I think this is very important. I don't want to.
Take your time. I'll actually answer a question. I'm laughing because I just saw this comment by Stefan. That's amazing. I actually love that because I'm a basketball fan. So thank you so much for saying that. This is a lot of fun to talk with Kevin, and you guys commenting just makes my day. Andy also made a comment here, so I'll answer that real quick. He said about the stronger yen, could that put pressure on commodities? He said, I don't see the yen strengthening soon unless the economy heats up. So once again, this is something that's important. So if you look back at just the markets in general, let's just talk broad market dynamics here. If we're looking at broad markets and we go, okay, well, if this happens, then this happens. Sometimes that's true. It's looking at intermarket analysis, for example. I use a lot of intermarket analysis. I really enjoy intermarket analysis. I think it's a great tool. However, it can be correlations change, and sometimes you can get stuck into those correlations. That's why you'll hear some of the old school trend following traders say like they don't use any type of filters or anything. And the reason in that is because correlations change. You don't know when the yen's going to move. For example, 2021 into 2022, I'm short the yen as I'm sitting there buying commodities, at the beginning. Well, not buying commodities. We were already long commodities at the beginning of that year, and then holding the yen to the short time as to the short side as we went forward. Also, I was long the dollar at the same time. None of that makes any sense, right? So you're long the dollar, you're long commodities. Sometimes the market doesn't make perfect sense to you, and there's lots of reasons why these things happen. So you have to understand that sometimes the market, these intermarket dynamics are going to change and shift, and sometimes you're going to have a situation where you have gold and the dollar moving higher together, or oil and the dollar moving higher together. We saw that this year as well. So you really have to take the trades as they come. However you do that, if you have a fundamental thesis why you should short the yen, by all means, go ahead and short the yen. You have a probability of winning. You just want to make sure whatever you're doing, you put the probabilities on your side. You're following your methodology, your system, however you do it. And just put on, to me, I just put on the trades. I set up my position sizing right. I go, okay, I'm only going to lose 1%. So who really cares at the end of the day? I get a certain percentage of trades right. I get a certain percentage of trades wrong. That's how you do this well and at a high level. Overthinking it, it's good to speculate, and that's what we do. We have to speculate and talk about things. But as a trader, if I'm just looking at the market, I would say, hey, like, let's say I'm short the yen and I'm also long commodities. I would say continue to do both. Don't even think about it. And you don't know also like what the dynamics, like Kevin said, you could have a weak U.S. economy, but a weaker Japanese economy, which could also be putting pressure on the yen, making the dollar go higher. And then you would still be long commodities at the same time. So, however you set that up, you just have to kind of follow your methodology. Go ahead, Kevin.
Yeah, I agree with you. I did send you that chart here, and then also one shout out to Andy because he's a rock star, and I do appreciate all of his kind words as well.
Yeah, he's great.
A lot of the commodities are also priced in dollars, so I'm not really too concerned about the yen. And if the yen does strengthen, is that going to put any pressure on commodities as a whole? Japan's not an exporting economy when it comes to commodities, right? So they're bringing pretty much majority of their commodities in house, or bringing them in house. So in fact, actually, the yen strengthening could actually bolster demand for purchasing those raw goods coming into Japan and then trying to work them. But the majority of the things that they export are services, one way, shape, or form. So that's one thing to kind of note there. Yeah, kind of going back to the copper thing, and what I was talking about, kind of like late cycle. I know you're trying to work on how hopefully you're able to pull out. Okay, cool. All right, so what this chart is really showing, this is the Commitment of Traders report. This is from the CME. I'm not sponsored by them at all, but they have really phenomenal tools. And what we're looking at right now is a chart that goes back 5 years or so, right? 5 years. And when you see the large orange lines, like the left-hand side, that means managed money is shorting, or they have net short positions, increased net short positions, things of that nature. When you see the blue lines moving to the upside, that means that they are net long, and they are, seeing they continue to buy contracts. Once again, when I talk about late cycle type of behavior, once managed money, once those speculators start to get into a trade or flood into a trade, that's when you want to just be cautious. It does not mean that you have to see an immediate sell-off. In fact, if we looked at June 2020, we continue to see long positioning kind of peak out, if you will. It peaked out between October, November 2020 to almost March or April of 2021, and prices stayed elevated. It doesn't mean you automatically fade these moves, but on the right-hand side of the page, we are pretty much at the same levels that we are seeing, or on the trajectory going to February of 2021. Once again, late cycle behavior doesn't mean that this has to fade. It just means that everybody is a part of the party now. It's not just those that really just trade commodities. It's the mom and pops that are like, hey, copper's moving. Let me buy some copper ETFs that have exposure, right? Like this seems like the trade. That's what we're getting to, and nothing against those traders at all. But once you start seeing that type of action, that late cycle behavior, those are very weak flows. They are not sticky flows. Producers have sticky flows because they're hedging inventories. That's what I wanted to call out. Last thing I will say though, Jason, here before we jet, crude. Oh man, I should have sent you the crude chart of this. This is the exact opposite.
I think you did. Right. I think you did actually.
Okay.
I think you did.
For the okay.
If I can find it.
For crude, And if we don't, we can kind of talk about it. Okay, so for crude, it's still in its flag formation. Last 2 weeks, we have seen a little bit of a move to the downside. People are freaking out, but actually last week was very telling. Last week, a lot of those speculators that we just talked about for copper, those same speculators for crude actually started chopping their positions down, getting out of their long positions, and we did see some pressure to the downside. We're also seeing the geopolitical premiums being backed out of a lot of these energy companies and things of that nature. Last week, we also saw $314 million of outflows for the USO, the ETF that utilizes futures contracts in order to gain exposure. A lot of retail traders utilize that. A lot of money managers use that as well. They're pretty much flushing out the crude side. They're pretty much saying, okay, this move's done. I'm on to the next thing. And Jason, I think that's great. I think that's a great thing to see. You're seeing this washout, you're seeing a reset, and now we're going to be trading on the fundamentals again. And last week we had some really good fundamental data that came out. We had a draw in crude, first time in like 4 weeks. Now will it continue to be a 6 million barrel draw? I doubt it, but it's nice to be able to see that. Operating rates still at around 88.5%. They're not spiking to 91, 92, 93. We have been pretty much at 87 to 88% over the last five weeks. What does that mean? That means that the throughput itself is not really expanding. We're just kind of just hanging out at these current levels. Exports also moved to the upside last week. Very phenomenal to be able to see that also occurring here. The structural underlying fundamentals of the crude market is starting to come back into alignment. And hopefully, if we see in the next couple of weeks, seeing the same type of trends, theoretically, you should see prices starting to advance. If we see prices advancing while managed money is fading these moves or even shorting crude at this point, washing out everybody, then that could also give it its second wind. Producers continue to increase their long positions at a pretty healthy clip last week. So that's another thing that I'm seeing. 28,000 contracts taken off the long side last week for managed money. Short positioning a little bit like that as well. But when you're looking at the producers increased their long positions by 34,000 contracts. What does that mean? Producers are literally buying all of that sell flow. And that's a good sign. They wouldn't be doing that if they did believe that the price of crude was going to collapse, if you will, moving down another $10 or $12. They wouldn't put themselves in that type of position. So I think might be another second win for crude here, maybe hitting that $90 level. I think that would be a decent use case. 80 to 85 still structurally sound as far as the range and profitability. But once again, we might see another a $5 move to the upside here because of this formation that's taking place.
No, I love that, and it's something that's incredibly important to understand just about markets is the fact that sustainable moves are probably the best moves you're going to get. Yes, it's not the funnest. Yes, it's more fun to see something spike like cocoa and be like, "Oh my God, this is great." But usually that's followed by a pretty hefty collapse. So this being a very sustainable move, kind of trading back to that range, and also it's a good value area. This is a value where countries and companies can both make money on this, and it's very profitable for these companies at the moment. So that $80 to $85 level. So once again, it's safe here. It's good to kind of see there's possibly a floor being put in there, and that could equal a move higher to that $90 level Kevin's talking about. For me, we're still long oil. We have trend following system, trend still up. As long as the trend's up, we're long, and we're just kind of sitting on our hands at the moment. So I do also think there's in the long term, there's a lot of reasons to think oil could move a lot higher. And in the short term, I do agree with Kevin where, we could easily hit that $90 level. And I know you got to get going, Kevin. Do you got to get off now?
Yeah, I got a jet. Man, I'd love to. I'll actually post the link under one of your posts on Twitter or X or what have you. You can check out that market prep. Kind of talked about the economic data that's happening this week, what to kind of look out for, explain those a little bit more. I talked about the crude thesis as well, as far as the underlying structure that's out there in this washout that we're seeing from speculators. So people can definitely check that out as well. And Jason, as always, man, I enjoy you. look at,
Same,
man,
man. It's a
something
lot
we
of
got to power hour this thing one day and just
yeah.
knock it out, because it's starting to gain traction. I love that everybody's watching, and by all means share, comment, we do really appreciate it. And once again, if you kind of go back on some previous videos, man, I mean, we haven't really skipped a beat. We didn't even talk about wheat today. It's pulling back a little bit though. It's testing that 200-week moving average, but we'll have to hit that next week, because
yes.
man, this something might be brewing, especially those tornadoes that occurred out in Oklahoma and Nebraska.
Yeah.
That's
And
hitting
not to mention, there was a nasty frost that went through here just the other day too. So there's a lot of things happening with Kevin's market prep. I'm gonna also make a post on that. I will retweet that. Also, people have been just telling me about a playlist, and I thought they were meaning on YouTube. And I was like, oh, I'll make I made one on YouTube, and they meant on Twitter. So I didn't know that you could actually make a playlist for all these on Twitter. I'll do that. Thank you guys for letting me know that. And I'll post your market prep on a retweet right now.
Appreciate you, man. You have a good one. Hope everybody stays safe out there and is profitable. Y'all have a good one.
And let's do this again soon. Maybe we could even hop on this week if you get 30 minutes to knock that out. So I'd love to talk wheat with you.
Down. All right.